Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we're working on the Chapter 5 short exercises. And in the last video, we stopped at 5-5. So let's jump quickly into 5-6. All right. So we're still using Score More Sports here. Uses the perpetual LIFO inventory method. It started, excuse me, it started on December with 10 helmets. Boy, I can't read. That cost $54 each. And again, this is just like problems 2, 3, 4, or 3, 4, 5, whatever it is. Right, so same data. All right, December 1st started at 10 at $54 each, which is $540. They bought on December 19th, bought 15 at 52. That's $780. And then on 12/28 sold 12 more. Okay, and now they're using the perpetual LIFO inventory method. Let's see here, which we had gone back and worked through anyway. So the December 19th purchase of inventory was on account. The December 28th sale of inventory was on account. And Score More Sports sold each helmet for 106. Prepare the required journal entries for the purchase and sale of inventory. Okay, so these 10 at 54 were already in our beginning inventory. All right, so now when we buy the 15 at 52, we obviously we're going to get an invoice, and it says they were purchased on account. So making journal entries, you know my thought process. Does this affect cash? No. Does it affect accounts receivable, accounts payable? Yes. And it's since we're buying them on account, it's an accounts payable, and our accounts payable is a liability. We know that we increase the normal balance of our liability accounts. We increase it on the credit side. So I'm going to credit accounts payable for the 780, and debits have to equal credit, so I have to debit something else, and that's going to be inventory for 780. So that's my journal entry for December 19th. Okay. And then number 2, it says the sale of the inventory. Let me erase this. Pause the video, write that down if you didn't get it. Okay, December 28th sale of inventory was on account, right? And they sold them for 106 each. Okay, so if they sell them for 106 each and I sold 12 of them, that comes out to, let's see, 106, that comes out to $1,272, right? And we're making a sale on account, so we're affecting cash? No. Affecting accounts receivable or accounts payable? Yes. We are selling them on account, so that's affecting accounts receivable. We know accounts receivable increases on the debit side, so we're going to debit accounts receivable for $1,272, and I'm going to credit my revenue account, whatever that is, for $1,272. And as always, when we make a sale, okay, we need to, and we're selling something out of inventory, we're going to have to make an entry to inventory. Okay, so our inventory is decreasing, right? Well, if the inventory is an asset account, right, and our inventory is decreasing, that means we're going to credit, the inventory account, right, because it's decreasing. And we had figured out that, let's see here, we were using the, let me go back. Okay, think through that. All right, I'm gonna have to work through it again. All right, so we're using perpetual LIFO, okay? And so for perpetual LIFO, right, so the last one's in where the first one's coming out, all right? So um, these are the last ones in, and we're selling 12 of them. So 12 at 52 is $624. So I have to take $624 out of my inventory, and since debits have to equal credits, where am I putting them? Well, I'm putting them in the cost of goods sold, right, for 624. Okay, and let me see here. Yeah, okay, that, remember I had worked through 5.3 and 5, if you watched the previous video, I had worked through 5.3 and 5.4. That's why in that same time I didn't write all of that down, but I just worked through it again. So just realize that you know, I ended up doing the work twice, but if you actually went back to problem S5-4 and you were working it out, you would have gotten the $624 as that cost on the inventory. Okay? All right, so that's it for 5-6. All right, 5-7. Consider the FIFO, LIFO, and average cost inventory methods. Answer the following questions assuming the inventory costs are increasing. So remember, the costs are increasing. Which method of inventory costing will produce the lowest cost of goods sold? All right, so when I made the 5-2 video, okay, I had talked about the different methods. Okay, so I'm not going to be repeating myself. Go back and watch the S5-2 video. In that I had explained LIFO, average, and FIFO. Okay, or actually it was FIFO and then LIFO on this side. But anyway, so yeah, you can just look at the answer here. All right. If the costs are rising, which will produce the lowest cost of goods sold. So for number 1, that's going to be let me erase this here and make that FIFO and LIFO over here. For number 1, FIFO is going to produce the lowest cost of goods sold. Number 2, the highest cost of goods sold is going to be the LIFO. And number 3, if the prices have been declining instead of rising, so now if the prices are going down instead of going up, which will produce the highest cost of goods sold, okay? And that would be number 3, FIFO. I'm not going to work through it. Go back to the 5-2 video, watch that after I work through the problem, and you'll see why, the thinking behind which one produces the greatest or lowest cost. Okay. 5-8, match the terms with the definitions. Okay, so I have full disclosure, materiality, consistency, and conservation. All right, so a company must perform strictly proper accounting only for items that are significant to the business's financial statements, reporting less favorable figures in the financial statements. A business financial statements must report enough information for users to make knowledgeable decisions, and a business should use the same accounting methods and procedures from period to period. Okay, so obviously using the same accounting methods and procedures from period to period is consistency, because we're staying consistent. Must report enough information for users to make knowledgeable decisions. Okay, so that's full disclosure. Reporting the least favorable figures in the financial statements, that's being conservative or conservation. And then, of course, number 1 is B, materiality. Right? I'm not going to spend too much time on this either. It's important to, I don't memorize what the definitions of these all are, okay? And accounting is not about memorization. I mean, if you said, give me a definition for materiality, I would have to go into the textbook and look it up, okay? But when I know the concept, all right, and I understand the idea behind materiality, and basically that understanding is that, if it's significant to the business, I have to report it. And that's what materiality is. Full disclosure, meaning, yeah, I have to, put out, all the information that's pertinent. Consistency, obviously have to, and that you can go back and watch one of the other videos where I was, I think it was 5-2, where I was saying you can't bounce back and forth between methods. Okay, that's staying consistent. And conservative, when you're making estimates, you can be conservative. Okay, you don't have to, you have to think about what it is that you're doing, and if you watch for those who pay attention to business, you know that financial statements, you can say, well, they're not accurate. You're always trying to present, depending upon what you're always doing, you're always trying to present the financial information in the best light, and that's absolutely true. With accounting, you want to be as accurate as you possibly can. However, there's always, I like to call it the fudge factor, where when you're dealing with estimates, well, you're not going to be accurate because it's an estimate. And things like this, we have different methods for different things in accounting, and depending upon the method you use, you're going to get a different answer. So which one's right and which one is wrong? Like, what's the difference between FIFO and LIFO? Or, and later on you're going to have depreciation methods. What's the difference between straight line, double declining balance, makers, blah blah blah. Which one do you want to choose? You can do them and you're going to get different answers. Okay, I mean, sure, the numbers have to be accurate based upon the method you use, and as long as you're, and that's what accuracy means in accounting. Is it's not my books have to be right. No, the math has to be right, and then, the method you use has to be justified. That's accuracy. So I know I went off on a little bit of a tangent here, but realize that you don't have to memorize these concepts. Accounting is not about memorization; it's about understanding. And like I said, I can't spit out definitions for these, but I do understand what they are, and I can apply them as needed. So yeah, here's the definitions. Just think through them and let them sit in your brain, because nobody's going to ask you for a definition on an exam or in the workplace. Okay, you can always go to the textbook and find that out, but you're going to have to use materiality all the time. Okay, you're going to have to use consistency all the time. Yeah, you're going to have to use full disclosure, and depending upon how you want to present the books, you can be conservative or not. Okay, right. So I'm going to stop here and pick up in the next video with 5-9.